Hey guys, welcome to Pumpy Dump Crypto. Anything you see on the show today is for entertainment purposes only. It is not to be construed as any sort of financial advice whatsoever. I do like to talk about what I'm doing and share those experiences. Hopefully they'll benefit you. And even if I messed up, hopefully you'll learn from that too. So I'm going to talk about this platform today called LedgerX. LedgerX is a derivatives trading platform. Derivative is a fancy way of saying something in math, like in calculus, but it's also a fancy way of saying something like a financial instrument that is deriving value from an underlying asset. In our case, the underlying asset is going to be Bitcoin or Ethereum because that's what we're trading on LedgerX. So when we're talking about options trading, what are options? What is an option? The term option refers to a financial instrument that is based on the value of underlying securities such as stocks. An options contract offers the buyer the opportunity to buy or sell depending on the type of contract they hold, the underlying asset. So when we talk about the opportunity to buy or sell, buying, if you have an option to buy, that's what we call a call option. The difference between futures and options is that a future, like if you're trading Bitcoin futures, that means that you are making an obligation, not an option, but an obligation that you're going to sell X number of Bitcoin at a certain price if you're selling futures. If you're buying futures for Bitcoin, it's an obligation to buy a certain number of Bitcoin or Ethereum at a certain price in the future. When it comes to trading options, though, the difference there is that you're not like making a commitment per se and then being forced to just deal with whatever happens later. Options contract is more like for a price that you want to pay, you are getting the right to buy or sell Bitcoin or Ethereum at a date in the future. And I know that all sounds really complicated. This is not something that I should be trying to teach in 30 minutes, to be quite honest. It took me a long time to get it, but I mean, hopefully through some examples here, it'll help you out in getting just a little bit about what's going on there. Options are typically bought and sold through online or retail brokers. In this case, we're dealing with this online broker, LedgerX, that was recently acquired by FTX. So you always have a buyer and a seller, okay? And you've got your call options and your put options. Let's take a look at what this kind of looks like on the actual exchange. Before we do that, I want to just quickly talk about LedgerX's options because there are some unique features here. If you've traded options on like Fidelity or maybe like any other standard kind of platform, for stocks and equities trading, it's going to be kind of different because here with Bitcoin mini options, the biggest difference I would say is the European style for these options. So a European style option means you can only exercise the option on the expiration date. So, I mean, I'll show you more about that when I show you what some actual options look like. American style call options or put options, those work where, like, let's say I buy a call option on Tesla and it's for, $1,000 in December and Tesla's trading at $1,200 and that is just a month from now. I can either keep riding it out to the expiration or I can say, no, I want to exercise my option to go ahead and buy those shares right now at the price of $1,000 because I think they're going to, I either want to turn around and sell it right now because I think it's going to go down faster or I want to hold it, whatever reason I have. By the way, research shows that waiting to the end with a winner tends to pan out better, by the way. My finance MBA textbook, I remember it told me that. So if I'm wrong, it's my brain's fault, not mine. Let's move on. Actual options. Here we are in LedgerX. And you can see, for example, right here in the middle, this is the expiration date. And in the middle, we have all these strike prices. On the right-hand side of the screen, this whole area, whoops, that's highlighting everything. like this area, whatever. The right-hand side of the screen is the put options. The left-hand side is the call options. Right here you can see it says calls. Right here it says puts. So what have I bought so far? Let's go with a real example. Here I have 36 contracts, 36 options to buy Bitcoin for a price of $10,000 per Bitcoin on the date, December 31st, 2021. It's a right. It's not an obligation. What did I pay for that right? Well, you can see right now, people are willing to pay $32,312. That's the highest bid right now to try and buy one. That's the rate that the cheapest rate, for buying these contracts. And the cheapest someone's willing to sell them for is $34,171. Here's our open interest, 7.7 thousand contracts being traded. So that represents what? 7.7 Bitcoin. And that's your liquidity pool. Like, the bigger these numbers are, the more they're being traded. The easier it will be for you to enter a position and get the price you want, or exit and get the price you want. But it's a two-way street, right? If you got low liquidity and like your asset's mooning and no one else is willing to sell and you're the only one willing to sell, there's advantages and disadvantages to everything. I just see it as a trade-off kind of scenario. In general, call options are a great way to, if you think a price is going to be achieved in the future, you want to lock in an exact date at a specific price point that doesn't go up and down. Because if you go onto like a leveraged trading exchange, like say Bybit or Femex, the biggest downside there is, you can get in and out anytime. But for that convenience, you pay a lot. And that's the funding rate. That's the funding fee. And the funding fee is also going to be more skewed. Options are skewed too. That skew is going to be based on how much interest there is. So in other words, if everybody wants to go long, going long means you believe in an asset. You think it's going to go up in value. Then the price of funding that is higher. Okay, versus if a lot of people believe that Bitcoin's significantly overvalued, so they're shorting it, they're buying put options, they're selling futures. Those are all reasons why they believe the price is going to go down. And I forgot what my point was. In that kind of scenario, it just means that the funding rate would be higher. Like if everyone's long, funding another long is going to cost more. If everybody's short, funding a short's going to cost more. If a lot of people are short but you're long, probably going to be cheaper for you. So being a contrarian can pay sometimes, like if you actually are right, like you're watching on-chain metrics. No, I'm just kidding. Who knows? Maybe it's all pseudoscience. But I think that it could be a competitive advantage for us. One more thing I wanted to talk about, guys, is in general, with options trading, futures trading as well, a lot of people just see this as speculation. They just see it as betting and risking for no reason. There is a legitimate reason that you want to use futures and options. That reason is to hedge your risk. If you are like 90% long on Bitcoin and everything you have is into that gamble that Bitcoin's going to go up in value, it might be a good idea to have some put options or some futures that you're going to sell at a price. Like if you know the market's up today, but you think in 6 months it's going to be way down, you need to take advantage of that volatility in protecting your business, protecting your money, protecting your investment. That's a big part of crypto too. Like for example, I'm mining and I have a lot that I'm getting ready to scale with, and well, for me it's a lot. It's small fries compared to the big guys. But bottom line is, one thing that miners do is they go and they buy a lot of derivatives contracts. That's one of the reasons I'm experimenting with it, is I want to understand how I can hedge my risk. Like I'm incredibly long Bitcoin, and I think a lot of people think that if you believe in Bitcoin, if you're a Bitcoin maximalist, that you should never bet against Bitcoin. Look, I believe in Bitcoin on a philosophical basis. Therefore, if I get eliminated from the market, someone else is going to replace me that may not believe in it as fervently as I do. Therefore, I think it makes sense that I stay in the market, I protect my capital. if I have to bet against Bitcoin because all the people that don't know a lot about Bitcoin are betting against it because of the hype or the fear or whatever, I got to play that sometimes. And risk management is a part of it. And I think anyone who's been in the space a long time is going to tell you that you need to learn some risk management. Farmers use derivatives contracts even for corn and soy are all over the place because the world is an unpredictable place, and businesses like to have predictability with cash flows so that they can plan for the uncertain future as best they can. That's what derivatives contracts are actually there for. Another reason they're there, some people say, is to keep businesses honest, because an asset class such as cryptocurrency gets a lot of flack. Everybody says it's a bubble and it's speculative and it's way overvalued. Well, if you believe in free market theories, you shouldn't be threatened because you could just short the ish out of it, can't you? And get it down to where it belongs. So, well, one way or the other, the market's going to decide, isn't it? All right, that's all I got to say about that. We call these derivatives markets, the options markets, as well as the futures markets. You can see here they have futures markets too. I haven't traded futures before. I mean, I've studied them, but I haven't traded them. So usually the quantity that you have to do is larger, but that may not be true here. Okay, going back to a tangible example. Here I got my 36 contracts that I bought. I'll go right here, positions BTC2. There we go. So you can see right here, I have the current size is 36. How much I paid for it, the premium to date, is $4,525.50. Yeah, I think if I go sell to close, I choose the contracts. I say 32,312. Okay, let's say I'm going to try and sell it right here at the lowest bid price, and I go to review sell order, and I confirm it. That's where I'm getting all this profit that I locked in, because remember I paid $4,000 for it. Because at that time, these numbers right here were like 12, 13,000. Okay, and they've gone up times 3 almost. So I'm in profit pretty good on this position. And I'll break this down on a spreadsheet too in just a second to show you guys a little bit more. I just wanted one more thing here. Whoops, this is the other position. On this position here, it costed $4,525.50 to buy 36 contracts. That's the right, in other words, to buy the right to purchase 0.36 Bitcoin costed me $4,500. You can see these numbers right here. 12,650. I got 17 of these contracts at this price, and I got 19 of them at this price. So it looks like, yeah, this executed first. Whoever was selling them ran out at that price, and I had to bid up higher to get the rest that I wanted. So in total, what I did on my spreadsheet was I took the average price of these two. I took a weighted average for the mathematics, because this is like figuring out my cost basis. Is that right here? Yeah, this is right here. So basically, I did a calculation somewhere down here, and I erased it later, but that averages out to about 12,570. That's how much people were paying 1 month after the May 19th crash. So this is about mid-June, I think, right? No, December. Sorry. Back in December, dude. So this is like when Bitcoin was 20K, I bought these options. And at that moment in time, people were saying, okay, we believe that, like if they were selling an option, they were basically saying, we believe that if you want to buy a Bitcoin at the end of 1 year from now, at the end of 2021, and this is, they're sitting there staring about, 17, 20K in the face, 15, 17K maybe at the beginning of December. They're staring at that thinking, well, we believe 1 year from now, the price probably isn't going to be much more. $12,000 for the right to buy Bitcoin at 10 grand. That break even is what, like at least $20,000, isn't it? Let's look. $22,570. In other words, if I bought the call option, I'm gambling on the fact that Bitcoin's going to be at least $22,570, not more than $10,000. It's tricky because it sounds like, $10,000 strike price. As long as Bitcoin's selling for a lot on the market, I'm getting a really great deal at buying it for $10,000, right? Well, people aren't. This is kind of like a price floor. So people who were selling these options were thinking to themselves, well, it's probably not going to go below 22,500. So they were using it for hedging too. For me, I was using it because I wanted to see if I could indeed pick up 0.36 Bitcoin at the end of this year, in another 4 months. Because how much would it cost me? Well, the cost for these options is fixed. It's a fixed cost because you could see that it's going to be 36 contracts with a $10,000 strike price is $3,600. So $3,600 plus $4,525. Well, it's exactly giving you how much I paid for if I exercise. Okay, only if I exercise, because a big part of that cost is exercising. Exercising them means paying $3,600. When would I exercise? When would I not exercise? Well, you could see here, theoretically, in this case, I'd lose 139% or 150%. Why would I lose that much? Because in both these cases, we're saying if Bitcoin was $5,000 or $3,600. So Bitcoin's pretty low in those times. Wait, what the heck is this? This shouldn't even be here. I don't think. Maybe it is. So with such huge losses, why would I trade with options? Well, I trade with options because at least I only lost 100%. I actually didn't lose that. This says I lost 6,325 or 6,829. That's just the result of the mathematics. In reality, I can't lose more than I put in, which was the option premium. And I'm not going to go and buy more Bitcoin if Bitcoin's trading for $5,000 just so that I can fulfill this order. I'm not going to fulfill the order. Who wants the right to buy Bitcoin for $10,000 at the end of December if it's actually trading for $5,000? It's useless. So in that case, I just lost all my premium, this $4,525. Well, here's why you want to buy it, though. Like, why I want to buy it. What if Bitcoin continues to even stay where we're at or go higher? In December, if Bitcoin was $135,000, I would be taking 0.36 Bitcoin, selling them on the market for $48,600, but I acquired them through this options contract for a total cost of $8,125. Therefore, I got $40,400 in profit, which is nearly 1,000%. I mean, it's 900%. Badass. Let's hope it happens. Okay. Second example, and this is a real world example as well. I have 40 contracts right here, and these 40 contracts were purchased, you can see right here, for $520.40. The rate was $13.01 for a whole Bitcoin. Now I want you to notice a big difference between these two call options. Here we had a much higher premium. They both were about close to the same proportion of a Bitcoin. Here we got 36% of a Bitcoin. Here it's 40% of a Bitcoin. And in this case, we paid $4,500, whereas in this case, we only paid $520. Why is there such a huge difference? Well, it has everything to do with time horizon as well as market expectation. These options don't expire in December, so we're just 4 months away from that. Whereas these ones, we have another 3. So we got like 7 months on this one. So you would say, well, that's great. Why wouldn't people pay more money for it? Well, because look, the strike price is $150,000. Meaning, if Bitcoin's trading for less than that, in fact, here's the break-even price. If Bitcoin's trading for less than $151,301, I made nothing. 0 at that point. So I need a Bitcoin price of at least 151.3K on that March expiration date on LedgerX if I want to indeed exercise the right to buy 0.4 Bitcoin or 40 contracts here on LedgerX I mean, I already have those contracts. If I actually exercise them, though, the cost to exercise them is going to be I have the right to buy 0.4 Bitcoin for $150,000. So it's quite high. You see this? Quite high. I'm going to need to find, at this moment in time, on that day in March, I'm going to have to find $60,520.40. I'm going to have to take it, send it to LedgerX, convert it to Bitcoin, or send Bitcoin there, one or the other. Then that covers the underlying for the contract as the contract executes. I'm going to have to put the exercise instructions there on the website too, I believe. This is what I think is going to happen. I haven't actually successfully gone through exercising a contract all the way yet. So, this is still a learning experience for me, but I want to share it, and I'm hoping you guys learn from where I go well or where I mess up. So another thing to contrast here that's interesting is there's another trade-off, right? Here we have to pay and lock up a lot more money up front for that safety, because look, most people are going to say it's a pretty good chance. When this contract was selling, Bitcoin was pretty much around 22,570, I bet you. So that's why the break even is set there. So we're at the beginning of the bull run. Did you think it would be a pretty good chance that a year out we would still be selling Bitcoin for at least that 22,570 level? If so, buying these call options is a good idea. But the downside is what we call opportunity cost, locking up capital. Look how much capital I had to lock. I had to lock $4,525 of my capital up. So this number, though, is nice and low because on the exercise date, I only got to go and find, 81.25 minus 45.25. So I got to just find that $3,600. That's it. Easy to find compared to having to make sure I got $60,520 in capital available for that exercise date. The good news, though, that I like about the moonshot one right here for 150K is look how little the opportunity cost is for me in Bitcoin right now. I only have to lock up here $520, same amount of Bitcoin, but huge amount of uncertainty. So options give you this fixed cost. You can, in a fixed way, quantify how much you want to gain or lose by gambling. And make no mistake, this is nothing more than gambling on the price. It's just like gambling with a lot of fancy words. Okay, here we got our puts. I didn't buy any puts or sell any puts. And by the way, buying and selling calls and puts are different. I've only talked about buying those call options. Even though you can't exercise the options anytime because they're European style, you can trade the options on the open market. And there's two ways they trade. This is kind of complicated because one way is if you try to sell your position, I think they call it sell to close or something, or I can't remember. If you try to sell that position in a certain way, they're like, okay, so you want to sell this, you need to back it with the Bitcoin. So they'll tell you to put a Bitcoin deposit. But there's another way to sell it where you're not actually selling it with the underlying. In other words, you're not covering the position. You're just only selling the option itself, trading the option itself, the premium. Okay, so I know it's a little complicated. If you have questions, leave me comments, questions, subscribe if you guys like this content. I hope you find it useful and helpful. I know there's a lot of stumbling here, but we'll get there. Okay, put option. Number of contracts 36. I just wanted to use the same kind of numbers here. And I also used the real number in the market, which was only $100 for the right to sell one full Bitcoin at $10,000. Now, this isn't based on what the market price was in December of 2020. This is based on today, so September 25th. As of September 25th, that's what the market is saying is the equilibrium point between the bids and the asks. $100. So it's quite cheap to buy this option. Well, you can see why, though. Let's try to look at outcomes a little bit. You can see that if Bitcoin ends at 15,000, this huge range here, in every case, you're losing money, in every case. And all of these, you're getting just wasted, right? Because they're all just 100%, really. It's just the premium. Unless you gamble the Bitcoin itself as an underlying, then you lose the Bitcoin. The Bitcoin went up in value, so technically losses can be infinite, just like gains can be infinite. There is that kind of mathematics that are involved with calls and puts. And really, like, if you're serious about trading calls and puts, make sure you study that first. Like, really do some Googling, understand how calls and puts and options work before, and just play with a teeny amount of money on your first. Like, I played with a couple of ones that were even smaller than this initially. So why would you buy this option? This is like the doomsday option right here. This is, you just believe that Bitcoin is the ultimate piece of crap, and it hasn't been determined yet, and it's about to be determined. You're preying on that black swan. I've seen the YouTubers out there. They just can't wait. They know gravity's pulling it down to 8K. That's what they believe, and those guys are going to buy these options because look at the. I think the word they like to use is convexity, it's just like it's asymmetric. Okay, the returns are asymmetric because here you only got to pay $100 for the right to sell a whole Bitcoin for $10,000. Now look, this doesn't pay off ever unless you're under the break even. The break even is just $9,900. Under that break even level, if Bitcoin's trading for $5,000, dude, you made 4,900%. You made $1,764 off of just paying $100. Actually, you only paid $36 because 100 was for a full Bitcoin, right? We're just doing 36% of a Bitcoin, like in the other example. So it does pay to be a bear sometimes. Problem is, in the long term of history, it doesn't, and it's hard to predict when the market's going to tank. We know markets, of course, they follow cycles and ups and downs, and Bitcoin has the greatest volatility. Compared to traditional markets, but we know other cryptos are far more volatile. Coming here to this last example, we have a strike price at 150K. You could see here the premium would be insane. This is based on actual data today. If I wanted the right to sell 4/10 of a Bitcoin, 40% of a Bitcoin, that right is going to cost me $42,000. If I wanted to sell a whole Bitcoin for $150,000, 7 months from now? 4 and 3, yeah. It's going to cost me $105,000 because people don't think it's going there. The market doesn't, at least the options market doesn't. They're willing to let you, speculate. That's what it's for. And the speculation says mathematically this data right here. It says that in every case, I want you to notice something here. We're doing selling here, because it's put options. We got the right to sell at a fixed number. See? No matter what the cost is of the strike price, the amount we get to sell at is fixed. With these options versus with the call options, the amount to buy is fixed, right? It's that premium, the option premium, plus the Bitcoin you have to buy on the expiry date. With the options that are put options, it's a fixed price, right? We're getting a guaranteed amount when we sell of $60,000. So the question is, and why is it $60,000? 40% of $150,000. It's always $150,000. Yeah, it's always $60,000. That's just 40% of $150,000 on the expiration date. It's fixed. I mean, this is what I'm going to get in as an inflow. My outflows, what I had to pay for all these rights, are variable, and the variable is $42,000, the total cost, plus whatever else the market was trading at on the expiration date. So if the market's trading at $78,000, so $73,200 comes from that $42,000 plus 40% of this guy, the selling price on that day. Because I got to go and buy Bitcoin, right? Like if I'm going to buy the Bitcoin that I got a right to sell at $60,000, I may already have those Bitcoin. If I don't already have those Bitcoin, though, I have to go out on the market. I got to buy up 0.4 Bitcoin. I got to put it on LedgerX because, I shorted it. And now it's time to take that Bitcoin and have it ready because I got the right to sell it. If I'm going to exercise, I'm selling it right now for 150K, which sounds awesome, but look, it's only going to yield me $60,000. And $60,000 doesn't cover my expenses, which was $42,000 for the premium, and then that other like 30-something thousand that I got back. Bitcoin needs to trade way higher for me to make money on that. I'm sorry, Bitcoin needs to trade way lower than that because, and here's how low. $5,000 would be rad. Because I got a strike price of 150K, so I get to sell this thing for a lot of money, way more money than people ever thought I'd get to sell it for, because it cratered. So, bearish scenarios, that's where you want to buy your puts. Bullish scenarios, that's where you want to buy your calls. Think about time horizon. Think about expiration. There's other variables. Black-Scholes formula for option pricing. It's complicated. It exists. I've read it. I don't understand it. Just want you to know it exists, okay? Additionally, you got this implied volatility metric based on the bid-ask midpoint. There is sort of an implication about how volatile, I guess, any given market is going to be. I don't know. I'm kind of learning here. All right, so if you guys like the video, please subscribe. Let me know your thoughts and comments. And, if you had any interesting scenarios that happened with options trading, let me know. Thanks. Be careful.